my mother was a 1 out of 10 mother, but she's like 12 out of 10 grandma. She just never gets tired of like going to the craft shop with the kids and doing grandma stuff and
Nice. Yeah.
yes, my wife gets a well-deserved break. My Thai mother, who we live with, gets a well-deserved break.
And you get back on the Australian wine.
Well, I don't really drink. I drink like shit. Last time I had a drink was with James and Timon in Bangkok like 2 months ago. So I'm not.
No,
I'm not a drinker. I
had a Thai mango wine once, and that
oh, that'll kill you.
it was like Sarson's chip vinegar.
Yeah, there's some poor choices to be made living in Thailand, but overall, Thailand is great. Love Thailand.
We can't. So, really, really excited to learn more about stablecoins today.
So today I'm gonna do something a little bit different than what I usually do. What I usually do is teach you a little bit of stuff, and then you bash into a big marketing presentation about how you should buy our FinRev system. I just haven't got the fucks to give for that. So I'm just going to teach a lot of stablecoin stuff, and then I'm going to open up our internal dashboards, and I'm going to show you a bunch of stuff that we're doing and a bunch of quanting that we're doing, and we're on a sprint now to make the biggest changes to FinRev that we've made in 2 years. Like, it's like amazing how much stuff we're adding, and you haven't seen a lot of this stuff.
No, because I mean, you guys have been off doing that mathematics, and
well,
now you translate it more into human speak. I'm ready.
Well, one of our programmers who also lives in Isan, Jack L, he's got a master's degree in maths, and Timon, being like super autistic nerd, he's got himself a maths tutor, and now he's like, I thought I have a postgraduate qualification in securities analysis, so like I know financial maths. Admittedly, I did that postgrad degree in jail, but I mean, who's quibbling? Like, I've still done it, so I still know the maths. And Timon has, in the last month, has surpassed my maths knowledge. James has a PhD in physics, so he's like, ain't no one no more maths than him. And yeah, and the other guys in the dev team are rapidly upskilling their statistics and maths knowledge. So it's yeah, it was easy to do my homework in the clique. I really enjoyed it. I also got super fit, and of course that didn't last. Good morning, everyone. JC has a PhD in physics. Hell yeah, man! It's as you walk through life, you open one door. Every door you open is a door that is another door that's closing, and that's something I didn't realize when I was young. And if I had my time again, I would probably do maths. Probably. Yeah. All right, guys. Shall we get into it? Are we good to go?
Yeah, let's do it. I'll get on the chat. All right.
Okay, so today we are talking about strategies for stablecoin yield, and today is the beginner day. We're going to do 3 weeks on this. It's going to get very, very advanced at the end, but today is suitable for numpties, and I'm a numpty, in a manner of speaking. It has been a painful 6 months since March, 13th of March. Why? Because we're using a trend following system. That trend following system makes money here, makes money when the market moves really fast, and then gives it back. Until we get a consistent trend, we ain't going to make any more money from our trend system. It's going to make money and then give it back, and it's going to make money and give it back until it breaks out above here or below here. Either one of those things is going to make us a lot of money. But until then, it's just kind of suck. That's just the way it is. Like, that's just the way it is. That's just being honest. But when life gives you lemons, you make lemonade, and the long-term returns are great. We're still up 80% for the year, 80% for the trailing 12 months. Like, it's not like, we're doing 3 or 4 times as good as anyone else. So, and if I look at my altcoin bags, they're all down 60 to 80% anyway. So the money that I've got in FinRev has made money, just not as much as I'd hoped, and it didn't lose any money, and everything else that I mean in crypto is down hatefully. So I'm okay with it. So I'm going to go deep on something that's fascinated me for a long time. It's fascinated me because it's what we all want, which is like earning money every single day. What we all want is this. Like, what we say we want is, I want to earn 1,000% this year. I want 100x. But if you want 100x, you have to be willing to risk 75% drawdowns. Most people say they are, me included. And then when push comes to shove and you experience it, go, oh, not like that. This really hurts. It hurts my feelings. So the stablecoin yield generation process, it's smaller, but it's very, very steady. It's not risk-free, and we're going to get to that in a moment. But the blend of these two, blending this into FinRev, is like going to be. So we're in the process of adding versions of this to FinRev. So it's a nice byproduct of we've got a big research push and development push on at the moment. I'm like, I'm driving these guys like, I'm working them like Africans. So we've got a team of seven devs, and they are being worked. So it's nice. It's a nice byproduct to show you guys how to do simple versions where you don't have to pay me anything to know how to do it. And you can earn anywhere from 4% all the way up to 50%. And that sounds weird. And the 50% is not free. It's not risk-free. 4% is close-ish to risk-free, but higher yields obviously come with more risk. And we're going to start at the beginning from simple and safe, and we're going to get to expert and nerdy over the next 3 weeks. And today's just kind of an overview, and we're going to do some simple ones, and we're going to start on the advanced ones. But first, some history lessons. The whole crypto market, it really depends on Tether, USDT. Now, USDT back in the day was this really greasy thing that no one knew who owned it. They knew one of the founders was an ex-child star, kiddie porn victim living in the Bahamas with really sketchy shelf companies, and no one could work out where they operated. And it probably started out as a sketchy business that couldn't be audited, but then interest rates went up and Tether got very, very popular. Like Binance, Bybit, every exchange depends on us being able to trade with Tethers. Why is that? Well, because if you trade in US dollars instead of US dollar Tethers, all of a sudden you've got to have an army of accountants accounting for every dollar that goes in and out. There's a huge cost to that. You effectively need a banking license. You need to be a bank, and you can't do that cheap. Like if you go to Coinbase and you transact on USD, trade Bitcoin for USD, you're going to be paying a large percent in transaction fees. If you go to Coinbase and transact on USDC or USDT, they prefer USDC. It's a lot less because it's just another magic bean. It's just another crypto. Now, this might have all started out as being a really sketchy, like maybe even a scam, but then interest rates went up. And what happened when interest rates went up is these guys from 2016, 2017, 2018, 2019, 2020, interest rates went up in 22. These guys have $100 billion in the bank, and interest rates went from 0 to 5%, and they're earning interest on it, and they're not paying you any of it. So all of a sudden, this went from being a sketchy scam to being probably the best business in the world. Their profit is $6 billion a year. In Q3 2023, last year, they made $2.8 billion in net profit for the fourth quarter of 2023. They have 50 employees. Their firm has less employees than my firm. And they earn the same as Goldman Sachs. Goldman Sachs has 43,000 employees. They are the 11th largest holder of treasury debt now. They buy, their profit is just from the interest on holdings freedom. And we're going to get to USD in a moment, Warren. So you have this company that through some historical accident that they didn't cause, they didn't plan for, like it's just lucky. These lucky bastards have the most profitable and simplest business in the world. And because they're the 11th largest holder of treasury debt, no one can really fuck with them now. Because if they're forced to sell all their treasury debt, the US government has a major problem, like a major problem. If someone's in there selling US treasury debt in $100 billion size, it becomes a problem for America. The US does not want them to liquidate. At the same time, other people have seen that business, which is so simple that I could run it part-time from my bedroom. And they want to steal their lunch. They want to steal that business. So the first one to try and have a crack, is USDC. USDC is a US regulated, Silicon Valley backed, Big Four audited, transparent competitor. They've got the backing of Coinbase. Coinbase is a big investor in them. They now have $34 billion in circulation and 34.6 in circulation, and they have 34.8 billion in the bank. So they have enough to pay everyone. So the first way, the first simplest and most retarded way that you can earn, and they have insurance freedom. This is very important. The USDC deposits on Coinbase will earn you 4%. And you don't have to do anything. You just leave your money in there and you get 4% for it. This is the simplest, the dumbest, the easiest, and the lowest way to earn yield on your stablecoins. It's not much. But you are, when you have it on USDC as opposed to USD in your Coinbase, you have no FDIC insurance. It's 5%. I think it's 5.1% now. But they use a dodgy calculation in the different. 4% is the real rate, and they're saying if you compound it continuously, then it becomes 5.1%. So they're using a little bit of girl math there, if you know what I mean. Inflation isn't 15%. Inflation is about 3%. There are trustless, verifiable on-chain solutions and hybrid models that we're going to show you today, which are a lot more effective. So let's understand it from a basic first principle thing. Money isn't free. If someone offers you to make you more money, like I've offered to make you a shitload of money with FinRev, there is a catch with that. The catch is you can make a lot more with FinRev. It's going to wiggle all over the place like a mad woman shit. If someone offers to make you more money, what they're not telling you is that you're taking more risk. Now, sometimes taking more risk is a shit deal. Like if you lent your money to Voyager or BlockFi in the last bull market, they were just taking your money and lending it to 3 Arrows Capital. That was a bad risk. You don't want to take risks like that. But there are times when you might get a better deal than normal. Why might someone offer you, me, guy trading from my pajama pants in my underwear, sitting in Thailand, why would someone offer me a good deal? Like, who the fuck am I? The reasons might be something's brand new and they want to incentivize growth. Like, if you had a big competitor like Tether and you wanted to grow fast, so you appeared to be as legitimate as Tether, well, you might be willing to give someone a better deal. If a specific chain, like some VC-backed bullshit chain that doesn't have a lot of real action, like I'm looking at you, AVAX. I'm looking at you, Atom. I'm looking at you, Arbitrum. If they want their chains to compete and they want more liquidity on their chain, because we told everyone we were going to be an Ethereum killer and we're actually not killing Ethereum, well, they might be willing to offer you a better deal, right? The other reason they might be willing to offer you a better deal is because it's a private company with no bankruptcy protection, and it's like a BlockFi or a Celsius, or the current version of that is in fucking Romania called Nexo. Fuck those guys. Don't put your money with them. So they might be willing to offer you more because you're just taking more risk and trusting some private company in Romania. Like, that's a fucking nutso idea in crypto. Don't do that. Or they might be willing to offer you more money because there's built-in or external leverage, which multiplies both gains and losses, which isn't so bad. So the important principle here is that who you lend to matters. Your counterparty matters. Do you trust them? Do you have to trust them? Do you not trust them? Do I trust BlockFi and Celsius with that Skaminski as the CEO? No, I don't fucking trust those guys as far as I can throw them. Never trust any slick talking crypto sales motherfucker ever. You know, we've had enough Sam Wankman frauds to know that you just shouldn't trust anyone at face value in crypto, me included. You just don't trust us. The OG players and the two biggest in the DeFi world are Aave and Curve. These guys have been operating for like multiple cycles now. They've handled multiple market crashes, including, most hilariously, the Curve founder borrowed against 40% of the supply of Curve to buy a $40 million mansion in Melbourne, you fucking retard. Everyone knew that he'd borrowed against Curve and crashed the price of Curve so that his loan got called in, and he got liquidated. The founder of Curve, the owner of 40% of the supply, got liquidated on his own loan in Curve. And what happened during that process was very instructive. Let's look at it. So what he did is he put up 40% of the supply for his own loan of $40 million. And this is when it all came out. So the price of Curve token dropped from 47 cents down to 22 cents, but it kind of stabilized. So what I'm saying is that it worked under pressure. All of the crashes we've had, all of the flash crashes, all of the dodgy loans, all of the FTX drama, all of the Sam Bankman-Fried drama, all of the BlockFi, all the Celsius, Aave and Curve. Yeah, this will be recorded. Yeah, the stablecoin stabilized at 50% and then it came back. They function perfectly. The rates on Aave and Curve, because they're trustworthy, are a little lower than some of the newer players. But personally, I recommend, it's crypto, it's the Wild West. If you have a choice in crypto between going with someone who you're 90% sure is still going to be there versus someone that you're 70% sure is still going to be there, you go with the 90% guy, even if he pays you a bit less. Which brings us to the point. There's a new player on the scene, which is why this is important today and right now. It's really good. Oh, how good is coffee? USD.E is a stablecoin. It is not the usual stablecoin. The usual stablecoin swaps a wire transfer for $1 million worth of USD, call it USDS, USD Scott. And you give me $1 million in cash, I give you 1 million USDS tokens. You have to just trust that I've still got that $1 million and that I haven't spent it. That's inherently not a great idea. Even if you audit it, even if the SEC is lodged entirely up my ass 24 hours a day, checking that I don't steal the money, don't spend it, Scott. Even if you've got the best protection in the world, it's not 100% foolproof, right? There's a better way. We have a thing called the basis trade. Let me show you what the basis trade is. The basis trade is the difference in the implied interest rate between futures and spot. So let's go down to our 3-month annualized basis. Let's look at it over the last year. So this is on Binance, OKX, and Deribit. You can see that this is the interest rate from going long Ethereum spot and short Ethereum futures. This is a carry trade. Richard, this is not like a carry trade. This is the carry trade. So you can see that the carry trade hovers between, before the bull market was like 1%. First stage of the bull market got as high as 16, got as high as 21%. Where is it now? It's about 7%, right? This carry trade basis fluctuates up and down. Can anyone guess in the chat what would make that fluctuate up and down? This is a good question. Any ideas? Why would it go through the roof in January and March when the price was... Okay, someone says Wales. So why would it have gone through the roof here and here? And why would it be in the shitter here? Close gap freedom. Liquidity, it's more the desire for leverage, but Lee has it right. Idiots are getting along. When the market feels like it's going up only, the faster it goes, the more tempting it is for idiots to lever up. And what I mean by lever up is go 10-to-1 leverage. If you're getting on Binance 25% or 27% for going long Ethereum, short Ethereum futures, you can lever that up 3 or 4 times. Now we're at 100%. That's looking very, very attractive. So this desire for leverage becomes a self-reinforcing thing. You can see here that it's just started to curl up. If this keeps curling up, this is going to become an awfully big deal. And this, right now, you can get 9 to 15% a year on this. It's gotten as high as 30%. This is driven by the demand for the leverage, which is highest in hot bull markets. So let's dive in. Let's go from the very simplest to the very hardest. Coinbase, you leave your money on USDC on deposit with Coinbase. You don't have to do anything. You don't have to do anything. They just give you 4% for it. They call it 5, but it's really 4. It's not bad. It's better than kicking the nuts. You can get more yield by lending to these private companies for an IOU. Nexo is the biggest. All of these companies are dodgy, in my opinion. Nexo is based in the fucking Romania. Up to 14% for investing in some Romania and getting an IOU from a Romanian company. You got to have nuts in your fucking head. Do not use these companies. This is all freedom. You can lock in that bank rate like a bank account. And we're going to get to that. Next easiest. Yeah, Wirex is very dodgy. Those companies are all dodgy, man. So instead, you could convert your USDT or USDC to USD.E, which is the new player. You just deposit that on Bybit, put it in your unified funding account, and you get paid interest rate while using it. They had a special rate this month, which was 20%. They paid 20% just to get you through the door. It's not really 20%. It's going to be closer to 5%. It fluctuates every day. They gave you like 20% for the first month just to get you using it. This is like a, introductory special deal. It's pretty good though. Like pretty fucking good. We can add this to FinRev, no problem at all. Now, the general principle that I want you to understand is that the newer and more niche the stablecoin is, like, for example, Justin Tron from TRX has his own stablecoin. Like, would you trust that guy? I wouldn't fuck that guy with your dick. There's no way I'd trust that greasy little shitbag. So the more weird and niche the stablecoin, the higher the yield, as a general principle. The more demand for liquidity on that chain. Yeah, I love Justin. I've got a massive position in Justin's coins right now. I mean, he's a shitbag, but he's doing the business for us. So, I can't be too critical. The more demand for liquidity on that chain, the higher the yield. And you can also get fixed yields. We're going to get to that. The uncomfortable question that you want to ask all these motherfuckers is, where is the yield has to come from somewhere. If it's just, I'm willing to pay you 20% per annum to borrow your crypto like Anchor did in the last cycle, where does that come from? Oh, it comes from crime. Okay. Oh, it comes from us lending your money to some really greasy other company who lends it to some really greasy other company. That's not okay. Yes, this is going to work in the US with DYDX. We're going to get to that. Chill, dog. So if you can't explain where the yield is coming from, very big red flag. So first of all, let's look at one of my favorite yield strategies. I actually use this one. I love this one. So there is a demand for USDC on Hyperliquid exchange. And let's load up the exchange. Let's go to Vaults. And let's look at their hyperliquidity provider. This is when they changed the algorithm to make it do liquidations. You can see that since about here, it's been a pretty steady and smooth march up. It has $247 million locked in this vault that you can pull out at any time. So you can just load your money up on Hyperliquid exchange. Instead of trading with it, you can get about 17% per year. Their maximum drawdown since they started has been 5.6%. So this is not a risk-free yield. This is not one that goes up every day. But it's 17%. It's pretty good. This is the next exchange we add to FinRev, by the way. And you can see this is their trades that they're doing, their market making. So basically, You contribute your money to them. They use it as market maker to provide liquidity to their exchange, and you get paid for that. It's not bad. It's not bad. I like this one. It's very simple to do. You just pick an amount that you're going to deposit, and you just click deposit, and it's done. It's not so hard. There's no math to do. It's pretty good. And you can see it's been quite steady and safe and smooth. It's been the opposite of FinRev. It's a quarter of the returns with a quarter of the bullshit. You see how that works? Quarter of the returns, quarter of the bullshit. Like, that's everything in finance is pretty much like that. They only started, this is a fairly new exchange, and this is when they changed the thing from December 28. So this is what it's looked like from December 28. And this is this is profit and loss. And you know, what if I still got some money with this? Yeah, it's not bad. This is not risk-free though. The next on the complexity scale is still pretty simple. Let's say you don't have a Bybit account, or you're in America, or you can't get one on your country. Woo, which is an exchange which is Ian's largest holding, was my largest holding. So let's launch the app and let's show you how to do it. Go in. So you click on fi.woo.org, connect your wallet. All right, we're connected. Let's go to earn. And we've got a bunch of deals. We've got 11% APR on USDC. USDC is a good stable coin. It's not going broke. It's not some dodgy thing. But check it out. We're on the Avalanche chain. What the fuck is the Avalanche chain? It's AVAX. So you're not on the Ethereum chain anymore. You're on Avalanche. So Avalanche wants to overtake Ethereum, so they're willing to pay you a little bit more. They're willing to give you a better deal. On Polygon, we're getting 11%. You can get 5% for your Bitcoin or 9% for your Ethereum, but we're not talking about those. If you deposit your Bitcoin with them, you have to deal with the Bitcoin doing this or the Ethereum doing this. With USDC, you don't have to do that. I don't even know what flash trade is, John. So if we look at, let's sort by APRs that you can get from Aaron, great question. The difference between WooFi and WooX. WooX is a centralized exchange. WooFi is a distributed exchange. WooFi is a DEX like Uniswap. It's just a straight swap. WooFi is distributed. You don't need an account. You don't need to give them your email. You don't need anything but a wallet. Woo, the exchange, you have to give them your driver's license, your passport, your name, your email, basically. So there's this thing called Mantle ETH. You want to invest in a coin called METH? Okay. Mantle ETH is Ethereum staked on the Mantle network. They'll give you 36% for that. No, it doesn't. No, this WooFi doesn't require KYC. Big advantage if you're not a fan of the tax man. But we're not talking about Mantle ETH and all these weird things right now. You can see that Binance wants your USD tethers, and they're willing to pay 9% for your USD tethers on BNB chain. But today we're looking at stablecoins. So your deals on stablecoins right now let's look at Arbitrum. Your total return is 13%. That comes from 8% plus 5% in Arbitrum. So they're going to pay you half in real money. They're going to pay you half in Arbitrum magic beans. So what you have to do is regularly take your Arbitrum magic beans and sell them back for real money. Did I just close my... Sorry, I just closed my presentation. Okay, so Arbitrum, so WooFi, it's pretty simple. And you can get, 14%, 14.72% on that. In John W., this is a great question. In DeFi, there's much more trust, but there's also much more hacking risk. If someone hacks the exchange, or hacks particularly the bridge, you have some problems. So what I recommend is stick to 3 players that have stood the test of time. Woo, Aave, the original, and Curve. There's 100 others. There's like 100 of others, but let's Curve. We're going to get to that. So notice you can get more for weird coins on weird networks like Meth. I'm earning 37% on my Meth. Like, I don't know. That ain't for me. I'm going to show you how it could be for you. But how do you do this in a practical sense? First, you need USDC on the network specified. So how do you get USDC on Arbitrum network? Well, the first way you could do it is take your USDC on Coinbase and withdraw it using the Arbitrum network to your wallet address. How does your wallet address look? You load up your MetaMask, and this thing up here, which is my MetaMask address, you just click copy to it, and it's the same on every chain. I've never heard of Cryptex, and there's 1,000 new players in DeFi, dude. The problem with new players in DeFi is that they're like a honeypot for hackers. Warren says I do it through an exchange. I don't really trust bridges. Very wise, because most of the money that's lost in DeFi is lost through bridges, and we're gonna get to that. So if your USDC is already in a wallet, it's not on a centralized exchange, you need to bridge to that chain. So there's a whole bunch of ways to get your USDC on Arbitrum on Ethereum to Arbitrum or to Avalanche or to whatever network you want. It's called a bridge. There's a bunch of different bridges. What you absolutely can't do is Google bridge Ethereum to Arbitrum. And I'll show you why. Because you're going to get, this one is real, but the chances of you getting a fake bridge, like this one looks like a fake bridge to me, that's just going to steal all your money. You should not trust bridges. I've had a good experience with the Arbitrum bridge to Arbitrum, but in general, for a bridge that can use everything, I use this one. I use app.dbridge.finance, and they charge a small fee, but you can swap from virtually any chain that you're ever going to want to use. And let's say you've got Ethereum in your wallet on one exchange and you want USDC on the other. You can choose what you want and connect your wallet and just whack away. This is a very useful bridge. I do use exchanges. Some things you can earn more money doing this on DeFi. Some coins you can't buy on exchanges. Let me show you an example. Can't buy Retardio on any exchange. So there's advantages to using off exchanges as well. Seville Photographer, I'm so tired of all the wallets that don't let you easily bridge. Yeah, me too, man. Just get in there one day, make a project of it, app.dbridge.finance. Just clean them all out, send it all into one wallet. This is the missing link to cleaning up a bunch of bullshit that you forget about. So what's the catch? Are you just getting money for free here? Fucking grow up, guys. Like, no one gives you money for free. It's crypto. They're trying to steal your money, not give it to you for free. So the catch with WooFi here is if you want your money back instantly, they're going to charge you a 1% fee. 1% doesn't sound like much, but 1% is a lot. Like when we're talking billions. Otherwise, they make you wait until next Monday at 0000 GMT to get your money back. Well, that's a bit of a fucker. They're holding your money for between 0 and 7 days. So you want to be thinking about when the wait to get your money back, it's a hidden cost. And if I ask you how much that costs, it's a real cost. You know it's fucking with you. You know it's costing you money, but it's extremely hard for a human being who doesn't know maths to work out exactly how much it's costing. And that's the catch. That's why they're paying you so much money. They're paying you so much money because they think that one day in the future, you're going to say, oh, fuck, I want to buy some Retardio, or I want to buy this, or I want to buy that, but I don't want to wait a week. I'm just going to pay the 1% to get my money out now. They're hoping you fuck yourself. And they're hoping that you're mathematically illiterate. PC Tune, you're wrong, dude. The money you spend on my software is much better spent on my software. Fucking absolutely no doubt about that. I'll defend that to my death. If you're looking at it on a day to day or a month to month basis, you're just playing yourself. You know, this is it's a thing that you look at the end of the year and go, how did it do at the end of the year? At the end of the year, it does about it. It did 80% in the trailing 12%. That's not so bad. If you look at it on how did it do today, you're probably better off leaving your money in the bank today. So the next, but the advanced but more profitable ladder is ENA staking. So ENA is the company that makes this Ethena. ENA is the governance token for Ethena. So first of all, you go to app.ethena.fi with an E, and you buy some Ethena. So you can swap your USD Tether, your USDC, or all your other bullshit stable coins for USDE. That's the first thing you have to do. The next thing you can do is you can stake this. So you can lend them, which is staking is lending. Your USDE, what do you get for that? Yesterday it was 4%. Today you're getting 4.3% for staking your USDE And what do they give you in return? They give you this other token called SUSDE. SUSDE is redeemable for USDE, but there's a catch. So they give you 4% and they give you SUSDE. The catch is it takes 7 days to claim after unstaking. Now, when you want your money back, you have to click unstake, and then you have to come back a week later and click claim. You can see what the catch is here, right? Like you have to set a yeah, anyone on the team can help you find your funds, Aaron. There's almost certainly they're not lost. So this is the catch. So you start off with USDE, you swap your USDE for SUSDE, which is staked USDE. You then take that, 4% isn't really sexy, right? But you take your SUSDE and we can send them somewhere else and lend them somewhere else for even more yield. Now let's head over to Pendle Finance. Now, most of these things, we click on the Launch app. We're connected. So you connect your wallet up here. Now, we're going to sort by our fixed yield. Now, most DeFi stuff is a fluctuating yield. It goes up or down with the demand for leverage. Pendle is a little bit different. They lock you in. You're locked in for a certain amount of days. Well, Time Wonderland was different because it was a centralized thing. You were just trusting time. All of these DeFi things, they're not centralized. So there's no real trust involved. So this is part of the thing. So you've got 4% on your USDE plus some SUSDE. I can lock this in for fixed periods of time. 55 days. I can get 55 days and get 9.5%. I can lock it in for 27 days and get 10%. What happens if I want to get out early? You have to sell it out at the market and you're paying the spread. The spread is between the blue line, the purple line, and the green line. So let's look at that. So you don't want to get it out early. So let's say you wanted to get it out today, instead of 11%, instead of 11.5%, you're getting out at 11% is the last guy to get out. So you can get your money back instantly. No, so your SUSDE on Ethena is not locked. You can get it back. You get a little bit fucked when you try and get it back early. That's the catch. Not completely fucked, like you're getting 11% instead of 11.5%. So let's just cover what we got here. We got 4.3% on our USDE, and then we're adding 27 days at 10.91%. Starting to look pretty decent. We're looking at 15% on stablecoins. This is not so bad, right? Like, who thinks that 15% on stablecoins is attractive? I'm actually interested in the chat. Do you think on a scale of 1 to 10, 0, that's not interesting, 15%, that's a balls out deal? Where are we? Do you trust parking your money in a trusted DeFi system in a cold wallet so that you can get a decent yield off your own money? These are the best yields currently available. When the demand for leverage goes up, and in March, these same things were like 25%. It's only because the market is down, there's low demand for leverage, that we're only talking 15%. So this is So this was up to 30% when the market was red hot, and it will go there again. But right now, it's back to 15%. It's back to, 4 to 15% because the market this is annualized. So this is not bad, right? The 17% on hyperliquid is fluctuating. It's gone higher, it's gone lower. The maximum drawdown has been 5.68% in the last year. For parking money, if it's not going to be used for trading, it's good. Like that's my opinion on it. Like it's nothing compared to what I can earn trading. If I decide to lock in and go balls to the wall, I can earn that in a month. But if I want to take a break, well, fuck yeah, it's not bad. You also get when you lock in some ENA points. So they give you a few ENA tokens, like an airdrop kind of deal. I'll get to FinRev. I'll get to FinRev results. We'll load up the internal dashboards and I'll show you. So they also give you some ENA tokens, which are pretty worthless. And I know this because I own some ENA tokens. And I own some ENA tokens, which I bought for $1, which are currently worth fucking 24 cents. Great investment, Scott. Fucking winning there. But it's still not bad. But what if you wanted more? So the two biggest trustless DeFi lenders are Aave and Curve.fi. And let's just take a quick look at Aave. And it's app.aave. Let's look at the markets. You can borrow Curve.fi for. So this is our supply. So Curve USD stablecoin, they'll pay you 30% to borrow Rocket Pool Protocol, whatever the fuck that is. USD, they're paying you 4.49%. So not much. The PayPal stablecoin can get 4% there. There's a few centralized places paying 20% on the PayPal stablecoin. I wouldn't trust those guys. You don't want to trust anyone that's just a company promising to borrow your money and give you back a high yield, and your guarantee is the company's IOU. You don't want to do that because we've already seen that company IOUs in crypto aren't very valuable. So Aave is the big one. The second biggest one is Curve. So Curve is a borrowing and lending facility for DeFi. So let's say you wanted to borrow some Ethereum and investing in Ethereum, or you wanted to borrow some USDE. They're going to let you borrow it at 4%. If you do this like Ethena earning points by borrowing thing. There's not much available. There's only 400K more available, and then you have to pay 30%. But let's say we want to take, don't forget we went to Ethena. Our first step was to go to, our first step was to go to, and they've got $2.89 billion worth of people doing this. So our first step was to buy Ethena from our USD Tether or our whatever USD into Ethena. That's free. Then we're going to stake that at 4.3% APY and get our SUSDE. We're going to take that SUSDE and we're going to lend it. How much are we going to get from that? we're going to lend CRV, which is the curve bullshit stablecoin, curve dollars, which is supposed to be capped, and they're going to give us interest. But of course, there's a bunch of tricky fine print bullshit in that interest. They're paying you in CRV tokens. What's the catch? Well, you're being paid in magic beans. So you've got to regularly swap those CRV tokens out for cash and restake them. USD ENA is the governance token of Ethena. Excuse me, my dog's going to keep barking if they're not ready. Come on, little dog. Where's my dog? Come on. Come on. What's up with you? I know. It's good to see you too. Sorry, Labrador. So the next thing we can do is lend out our USDE, and they'll let you lever this the fuck up. So we could, they'll let you lever it all the way up, as much as you want. Way more than is practical. They want you to get liquidated. So we're using our SUSDE as collateral to lend out CRV USD. They're going to give us 15% paid in magic beans, but they're also going to let us use leverage. So if we use 2-to-1 leverage, that becomes 30%. If that becomes 3-to-1 leverage, that uses 45%. Now, in what circumstances could we get fucked doing that? Well, if the value of this CRV USD token fluctuates, we can get fucked. It's not an arbitrage. It's just lending. So what are the risks? The risks are that your funds get hacked, that the risks are that you're being paid partially in magic beans in curve, that could go to zero, that could get hacked. The rest of the risks of like a BlockFi or a Celsius coming and stealing your money and saying, oh, well, we haven't got it, like that's not a risk. So so it's definitely not risk-free. It's definitely more risk than leaving you, and there's no FDIC insurance. The big risk is this CRV USD coin is not stable. So you can see that this depegged at one stage. Everyone who was using leverage then got fucked. So you are taking a risk of the stablecoin being depegged. Leverage is dangerous. Leverage multiplies your gains and multiplies your losses. In a black swan event, the CRV USD peg might break like Luna. Let's look at how other stablecoin pegs have broken in the past. So this is daily chart of USD Tether. It's gotten as high as $1.20. It's gotten as low as 94 cents. I'm not talking about the stablecoin. I'm just talking about USDE on one place and staking it elsewhere. It's too early to know if it's ever going to mechanically depeg. So if you're not using leverage, there's no risk at all, because it doesn't matter, because these pegs will always return. Like you can see that as the value of a stable coin goes up, it'll eventually come back down, usually within a day. If you're using leverage, if you were using more than 5-to-1 leverage and you were doing the USDC thing, you would get liquidated here if you're using more than 5-to-1 leverage. So what I would say is that 2-to-1, 3-to-1 is the maximum leverage that would ever happen. And some of these the dodgier stable coins, which I'm recommending you not doing, also have a higher risk of depeg. If you're trusting Justin Sun's stable coin, so this is Justin Sun's dodgy stable coin. You can see it regularly fluctuates as low as 93 cents and as high as $1.04. If you use 50-to-1 leverage on that, as soon as it gets to here or down to here, you get liquidated. So Justin Sun's stable coin, I mean, it's not bad unless you're using leverage. But if you're using leverage, this is a no blend. This is a no good situation. So it's a lot like everything else in finance. How much risk do I want to take? Do I want to risk losing all my money for making 35% a year? No. Do I want to take a small risk for earning 20% a year? Yeah, I probably do. Do I want to take a very minimal risk for earning 15% a year? Yeah, I probably do. The way that I'd like you to think about this, leverage is salt. Put a little bit of salt on your steak, it makes it taste way better. Warren Buffett's returns are almost entirely because he uses 1.3 leverage. That's what he does. Little salt makes the returns taste better. Ever put too much salt on anything? It just completely ruins it. It's inedible. So we're going to dive deep on this, and I know it sounds confusing and complicated and easy to fuck up. And, you know, we're adding this and a bunch of other stuff into our automated systems. And usually I give a marketing heavy presentation, but that really bores me and I don't want to do it. So I'm just going to show you under the hood of how our shit works. And I'm going to show you the changes that we're making at the moment. We're currently in the process of implementing the biggest series of changes that we've ever done. So let me just log into our dashboard. It's my favorite account, and let's look at the last 12 months. So this is various volatility targets, 35, 40, 45, and 50. You can see over the last 12 months, we're between the top performing account was 78% over the last 12 months. The 35 vol accounts have performed 57%. This might look like, oh yeah, I want this top one. But if you look at the way that the 35 volt has performed, it's a lot quieter and easier to live with. It's not boring, but it's not like exciting. You haven't like made a lot of money and then lost it. No, Marlon, you don't need a separate FinRev account. So let's look at how much we trading by exchange. So you can see that we're gradually migrating our users off DYDX version 3 onto DYDX version 4. You can see that that's steadily rising. And we've got $13 million worth of total money running, and The only exchange that I'm unhappy with the performance is KuCoin. What else am I going to show you? So what I'm going to show you, like over since 2019, this really has done a little under 100% per year compounding, which works out to some eye-popping thing when you run it for long enough. It's running at a high Sharpe ratio. It's still running at a high Sharpe ratio. Today you're going to see a press button. There's very little marketing in today's thing. It's just all going to be real numbers. You're going to see a press button make money system that makes money every year since we started in 2019. It's never had a losing year, has 4.5 million of our own money, making 100% per year, earns risk-adjusted returns better than George Soros and Ray Dalio put together. It's not for every single day. You just can't. It's not like the stablecoin stuff we just discussed, that the money goes into your account every day and you're earning every day. It's not like that, but it does work in bull and bear markets. It does work really well when everything goes bad in crypto, in the FTX debacle. You don't need to know anything about it. It requires zero knowledge. It runs on autopilot. You don't need to check it at all. It takes 3 minutes to set up. If you can set up Netflix, you can do this. It doesn't require any technical skill. It takes the risk out of crypto because it makes the money like clockwork in bear markets. The big problem with crypto, in my opinion, is that this is the total altcoin market. You buy in here and you can be down 90%. Most altcoins, if I pick an altcoin that I really liked, like I liked this so much, I bought 50 grand worth of it at $1, and now it's worth 25 grand. Like that's that doesn't happen with FinRev. 4 of the 10 biggest hedge funds in the world still use it. Use just it. It's created countless billionaires and multimillionaires, like John Henry owns Liverpool Football Club and the Boston Red Sox. Cliff Asness, he runs $150 billion. Now, I want to show you something interesting. These are the results that I used to show you. I was up 149% for the year at one stage. Couple of losing months. Now I'm only up 100% for the year. This is my TradFi trend following. So the problem with trend following is it wiggles around a lot, but you're probably getting the idea that finance is very definitely an area where you don't get shit for free. I get paid for being putting up with, yeah, I'm up 150%. Now I'm only up 100%. And I lost 21% one year. So it's based on the oldest and most consistent way of profiting from any market, which is trend following. Trend following is the simple idea that once a coin starts going up, it's got a higher probability, a very slight higher probability of continuing to go up. My retirement accounts, I swapped to this in late 2019. It's been pretty good for me. It's been pretty good. I've kicked the S&P's ass. I mean, I've done this with my own money since like 2014 was when I put in my first real pro level trend following system. This is an index of every trend following firm with a track record longer than 10 years. The gray line is the S&P 500. You can see it kicks its ass. Has some losing years. 1, 2, 3, 4, 5, 6, 7 losing years out of 22. Is there a prevailing sort of source literature? I would recommend books. I recommend Katie Kaminsky, Crisis Alpha. If you want a beginner introduction, is Andreas Plenovs, who's a friend of mine, Following the Trend. If you want something that's closer to what we do, that's like halfway between like the stuff that you won't understand and the stuff that you can understand, Systematic Trading by Rob Carver. Those are 3 books that I recommend. So Cliff Asness, who has a trend following firm, he worked out how much it made every decade since 1880. you could see that you might have 6 losing years out of 22, but you have no losing decades. And that's important. You know, I had a customer cancel with me yesterday. He's like, I really wanted to stay with you, but you were up $3,000 during the month and now it's flat. That's unacceptable. Like, yeah, I'll give you your money back. Investing's not for you, dude. Like, that's just not the way it works. Like the best guys in the world have losing years. Trend is a lot better than TradFi just because it's newer. So we don't have losing years, but we definitely have losing months. There's no one in FinRev who hasn't had a losing month. So what I'm trying to say is that trend following is a law of gravity. It works in stocks, it works in bonds, it works. You can see it in real estate. If you've owned real estate in Canada or Australia, why does real estate in Australia go up? Because it's always fucking gone up. Why will it keep going up? Because every motherfucker wants to buy a house because they're afraid if they don't buy one today, it's going to be out of their reach. This has happened in Canada, Australia, Vancouver. It's happened in stocks, bonds, real estate, FX, commodities. It happens everywhere. It's happening in gold right now. It's worked for 10,000 years. Why? Because it works on human greed and human fear. When shit starts going down, we get scared and sell, and selling makes our prices go down. When shit starts going up, we go greedy and we start buying more. The real thing, what we call the greatest discovery in little guy finance, is that works really much better in crypto. And you can see if the yellow line is Bitcoin. Bitcoin wiggles around a lot. Like you make a lot of money and then you lose half of it, and it looks like it's going to be okay. It's not okay. And then it looks like you're going to make it all back, and you didn't make it all back. And then it looks like it can't get any worse. And then Sam steals all your money, and then now we're back up here. But it's just a wild, unpleasant ride. So instead of talking about it, let me show you. Let me show you how this shit works. This is our trading system. We run it on all these coins. We're running it on 100 different coins. Why are we running it on 100 different coins? Well, because there's a lot of luck involved. How do you remove the effect of luck? You take a lot of swings at bat. The best way to take a lot of swings at bat is to trade 100 things. And there's a mathematical property of it, which is that trend returns, and all returns actually, scale infinitely with the square root of the number of independent bets. The more coins you trade, the more money you make. End of story. So we make a forecast of what we think the market is going to do. This is based on a blend of all of our different trend features and all this other stuff that I'm going to add. I'm going to show you in a minute is going to be added to this. It's being added to this. When that trend is positive above this line, we're betting that the market goes up. So you can see we started betting that the market goes up, and we start banking profits as soon as the market slows down or starts going down again. And we banked our profits here, and then we got back in, and then we started banking profits here. And around here, we've been shopped around to shit. We got short. We made a little bit of money. We gave that back. We got long. We made a little bit of money. We gave that back. We got short again. We made a lot of money, and we gave all that back. And then we got long, and we gave it back. While we're chopping sideways, trend following is a very, very frustrating situation. And you can see that in the last 30. Let's look at the last 90 days. You can see exactly that. We made money, we gave it back. We made money, we gave it back. We made money, we gave it back. It's like the last 90 days were up like 5%. Big fucking deal. It's a frustrating strategy until we get a big trend. Once we get a big trend, we're off and running. How does it work? It works because this is all the coins that we trade overlaid. And you see, this is earlier this year in the bull market. This clear winner was TIA, scammy VC coin. If we follow this line way back, you can see that very early on, TIA started to outperform and eventually became the winner. You can see that also with Solana was outperforming earlier. All the coins that win, they start to outperform. And this is the 2021 bull market. Dogecoin and Matic were the big winners. You can see they really start, and Solana. You can see they really started outperforming early. And this is algorithmically what we're doing. We're taking a basic fundamental property of markets that people like winners. This is the second half of the bull market in 2021. The winner by knockout was Sand USD. And we owned this coin. I owned it in size. This was like a coin that made my life. Just going to show you something cool here. This red line up here, I never took it off because it was the best exit I've ever done. Was bought sand here, sold it on this day. Best one I've ever done. Fuck yeah. So anyway, we noticed this. Notice this. I bought some sand in my personal account, as well as trading it in the system. And I sold it here. This was a good thing. So this is, if you want to know how do I pick coins, like you don't pick it by asking your mates or asking me, you pick it through this. But we've automated this. So you now possess with absolute certainty which coins are going to move. Now let me show you how to take all the thinking, the guesswork and the uncertainty out of it. And we're going to double your money or very close to it. We're going to double your money on average every year on autopilot with this. And the theme of today is ain't shit for free. You want that 5% in your money bank in your bank? Well, that probably is for free. You want 100% per year, you're going to have to put up with some bullshit. And that's what putting up with some bullshit looks like. At the end of the year, it looks great. At the end of any individual day, kind of sucks. That's just the reality of it. On every individual day, I don't know, we've got a very, very slight percentage of chance of making money. So I'm going to show you how to ride this bull market for all it's worth. And then the idea is you hit a winner on a big coin, you've got a retardio, you've got some coin that you think is going to play out. You really, really want to secure that bag. You don't want to ride it up and then ride it all the way back down. You want to stick it into something like this or the stablecoin thing, which we've just discussed, and let it compound over time into rich guy money. Because let's say you bought Bitcoin in 2019 for $3,742 at the perfect time. It's done 57% a year, but our system did 107% in the same year, in the same time. But if you look at the swings that you had to endure in yellow line, the Bitcoin, ours was painful in that you were going sideways, but you weren't actually losing your money. So let's say you wanted to buy a house. I cashed out enough to buy my dream house this year. It didn't hurt me. I didn't have to wait for Bitcoin to come back up, right? If you bought at the absolute tippy top of the last bull market, you've doubled your money every year since then. You never have to try and time the exit perfectly, because that's incredibly hard. I didn't pick the recent top. You didn't pick the recent top. Let's not pretend I'm some fake guru bullshit here and I told you all to sell at the top. I did that a couple of times, but not the top. I did not pick it. But not experiencing a losing year, never getting stuck holding the bag when the bear market hits, that's worth something. If you put 10 grand in this in 2019, you'd have $380,000 compared to $110,000 in Bitcoin and 146 in alts. The point about compounding is the big returns come at the end. So you put you're up to 380 grand after 5 years. That's a lot of money, but you're within sight of what I think most people's goal is a fuck off. What I would call fuck you money is about 10 million bucks anywhere in the world. 10 million bucks, there's ain't nothing you can do. So after 5 years, you're within sight of fuck you money. Now, if you wish you had a time machine, Marty, we got to go back to 2011 and buy them Bitcoins. This is the next big thing. Done this in the old market since 2014. This is how I've made 90 cents out of every dollar I've ever made from markets. My retirement accounts are $10 million. It was a bit higher than that. I'm pretty glad I pulled out some money to buy a house, actually. We've been running it on crypto for years now. The results are incredible. All the results I've been showing you have been after fees and costs. We offered it to our best clients in the middle of the bear market while everything was shite. And this is what it looked like in the bear market. It was 100% in the bear market at a Sharpe ratio of 1.7. We promised to double people's money in a year. Every single person who has used this system for a year has made money. Everybody wins, no exceptions. It works. I showed you basically how it works already, but let me show you the new stuff. Everyone's pot of gold at the end of the rainbow is 10 million bucks, dude. Unless you want to be a wanker and own private islands, and well, actually, I do own an island, so call me wanker for that. But unless you want to have private planes and, you know, Patek Philippe watches and all that shit, like 10 million bucks is enough to do anything you want for the rest of your life, too, guys. If you can keep your hands off the steering wheel, it's going to make you rich in 5 to 10 years, no matter how small a grub stake you're starting with. But you can't mess with it. You can't not worry about day-to-day fluctuations. You know, I had a customer quit yesterday. He's like, I was up $3,000 during the month, and now it's back to break even. That's not good. That's not good enough. You should have banked profits. If that's your attitude, you can't be a customer of this. This is not for you. You're better off with the stablecoin stuff. You got to be in it for the long term. So my goal for you is the ability to do whatever you want, wherever you want, with whoever you want, for as long as you want. Most people use their time to buy money, like they go work as a wage slave and then get paid a little bit of money and then give half to the tax man and then spend, and then whatever's left they live off. I want it the other way. I want your money to buy your time, so you do whatever the fuck you want. Is there anywhere to see monthly, weekly returns for FinRev? Yeah, sure. I'll email it out to everyone today. I email it out regularly. Let me pull it up right now. That's a really good question. No, that's monthly returns. Yearly returns. Worst 10 drawdowns. Yearly returns. Yearly returns. Yeah, here we go. This is a yellow is Bitcoin. This is our strategy. I've got a more updated one, which I'll show you in a little bit. Let me get back to that presentation because I'm burning time here. You guys should probably be able to tell that I'm not like trying to hide anything from you guys. Like I'm legit proud of what we've been able to achieve. I'm proud of our returns. Our returns are objectively industry-wide standard, incredibly good compared to professionals in hedge funds, because I'm friends with a lot of them and I've got some of them working for me, and it's the honor of my life to improve this system. It's the best and only good thing I've ever done with my life, actually. It's the honor of my life to grind like an animal every day for this community and making everyone, including myself, generationally rich. Fuck yeah. Got one more thing to show you. And what if you could earn twice as much as the system I've just shown you? What would that do for your life? How much faster would that get you to your freedom number? If we're talking about 100% per year, which is about what we do now, compared to 200% per year, and I'm going to show you how we're going to get you to 200% per year in a minute. You can see after year one, it's a little different. After year two, it's pulling away. After year three, it's ludicrous, and then it gets nuts. So how the really big algo trading firms do is they blend multiple systems together. This is how it all works, because as you've seen, Trend is amazing, but Trend also has these sucky periods, these sucky periods, these sucky periods, these sucky periods. So the idea is if we blend some systems that aren't sucky at the same time as a system that is sucky, we're going to earn less money in the good times, but it's going to be steadier and smoother, and overall we can lever it up. The whole is more than the sum of the parts. So right now we are on a 2-month sprint to make the biggest changes we've ever made to this system, like the biggest changes. Now let's go through them. For any of you who have the system now, this is all coming to you pretty soon. So right now we allocate capital between all of our various systems. These are our subsystems, depending on how much money they're making. And everyone gets this, including the gold members. So for example, Bitcoin has a Sharpe ratio on some of our systems of between 1.72 and 1.49. So you can see that its portfolio weight, Bitcoin is 7% of the system. If we compare it to Ethereum, Ethereum has a lower Sharpe ratio, it's still pretty good. So it's only getting 2.8% of the system weight. This is how it works. Right now, we're weighting this on all the data we have. Why? Because our original theory was that more data is better. We can be more certain with more data. But Superquant James, you should all be following him at the Robot James on Twitter. He has a very good website with the best trader education you've ever seen. Is free, much better than anything I've ever charged for, is for free on his site, robotjames.com. Much better than anything I've ever charged for. And I know because he's like one of my best mates and we chat every day. So what he did is he worked out our correlation of our feature performance. Our features are these things here, with our next day returns, with our next month returns. And you can see that a rolling window of between 5 and 7.5 months is the sweet spot. So we're switching to a 6-month rolling window. You can see this explains 22% of the next month's returns is how well it did last month, which is amazing. If we want to compare that to how much our actual features, you're going to love this. So all of our different features, Bollinger Momentum explains 2%, 2.2% of the next day's returns. Breakouts explain 1.37. This is our average. Moving average crossovers explain 1.34. We have these two laggards here. We're going to kill these two. These two have consistently underperformed. They've underperformed on the last 6 months. They're the bottom. They've underperformed on 12 months. They've underperformed on 90 days. They're last place for 30 days. So we're just going to kill them. Sure, we put a lot of work into them, but they're just not. But our average is our average is going to be improved by getting rid of these two. So we're taking that out. We're also changing the rolling window. We're changing the fitting process from all the data we have to a rolling 6-month window, which is a dramatic improvement. Now, this is our correlation of our trend forecasts with our next day vol adjusted return. So this is after day 1, day 2, day 3, day 4, day 5, day 6, day 7, day 8. You can see out to about 0.0000 is a coin flip. So you can see out to about 17 days, still just better than a coin flip, but the first 12 days or so is the sweet spot. And obviously, executing faster gets us more edge, which is why market makers have more edge. They execute faster. So we're in talks now to team up with a market making company to plug their market maker on the top of our shit. There's some other stuff that we've discovered, is that this is the volatility decile of how much the coin wiggles. The big coins, Bitcoin and Ethereum and Solana, wiggle a lot less than the small coins, the shit coins. You can see that our correlation, our trend features are much more predictive on Bitcoin and Ethereum. So if we look at our trend features are like sharp ratios of 1.24 on Ethereum Classic. Let's look at Ethereum Classic, and you can see it's way worse. Ethereum Classic is a fake ass shitcoin. So we can adjust our features, do what's called vol normalizing them, and get a substantial improvement. It's all nerd stuff, but these are all improvements that we're making right now. We have a new system, and the new system is called cross-sectional carry. We've been running it in our own accounts. It works fine. It works. So it's a little bit more difficult than trend, because trend we have 12 days. This is day 1, day 3, day 5. You can see that that carry works 3 days is the sweet spot for us. So we're using um, 3 days is the sweet spot that we're putting in, and this is what carry looks like. So carry isn't like trend. Trend goes sideways and then makes money, and goes sideways and makes money. It's very frustrating. This makes money almost every day and then shits the bed. Makes money almost every day and then shits the bed. Makes money all the day, shits the bed. Makes money almost every day and shits the bed. Carry is available right now. We're implementing 6 different features all at once, because what we realized was when we were going to turn carry on, it's like, hang on, carry is conceptually similar to a bunch of other things. So we have to refit the system every time we add a new edge. It's like a big couple of month process. It's like, why don't we do 6 at once? Why don't we fuck it? Why don't we just go from 0 to hero all in one go? So that's what we're doing. So this is what carry looks like on a friend of mine's system who has fast enough execution to have 12 to be in and out for 12 hours. So his sharp ratio on a 12-hour hold is 2.8 compared to, 1.3, 1.4 for us. So his better execution gives him a better sharp ratio, which is what you can see. No, you don't need support to turn carry on. This is what carry and trend blended together at a high vol target. This vol target is a little high because you can see the drawdowns are 24%. And eventually you're going to get a 30% drawdown. This is too wild for most people. Oh, hang on, no, this is not that at all. This is not that at all. That's something else. Excuse that. This is our drawdown plot. This is our real world draw. Carry has been rolled out in my account, so I'm currently actually losing money with it. We're rolling it out at the same time as all these other things, which I got a meeting after this to see when it's done. They say 2 more weeks, but I'd say reality 3 or 4 more weeks. But I'll show you. Let me show you all the rest of the shit we're adding. So these are our real world drawdown plots. Early on, we had some more drawdowns. the system optimized itself, drawdowns were low, and our recent drawdown is just a bit over 20%. So you got 80% for the last year with 22% drawdowns. Now, this is a new system that we've designed. This is what some people call cumulative volume delta. Our carry is already implemented with FinRev Platinum. We just haven't turned it on. Why haven't we turned it on? Let me show you. Why didn't I turn it on? Because it lost money earlier this year, and you guys, and I wanted to wait until it started to make money before we switched it on. Also, we've got some new versions that are related to the research on carry that have improved it substantially. So anyway, so let me show you. There's a thing, if we measure the amount of volume that trades at market orders, like someone hitting the market buy versus the market sell. A market buy order is an aggressive order. Market sell order is an aggressive sell order. There's information in that. So when we plot the strength of that imbalance on a 7-day imbalance decile, you can see that broadly speaking, we have this sort of up and to the right relationship, except for this. This is caused by short squeezes. So what we're doing to turn this into a system, slicing out the tails on both ends. And we're just trading this. And it turns out that cumulative volume delta, let me just stop sharing, restart sharing so I can kill the annotation, is a very strong edge. That looks pretty fucking good, right? This is a costless simulation, so it's not quite, so it's not going to be that amazingly good because we've got some costs involved, but still pretty fucking good. This is the equity curve that when we blend it with trend, when we blend it with carry, is going to take things to the next level. This was the last 2 weeks' work for us. We're very proud. Unfortunately, it works better on the top 50 coins, which is kind of a shitter, but we got a plan for that. In fact, it works better on the trash coins, whereas trend works better on the big coins. So the other stuff that we're adding, we're going to add all this in one go, is cross-sectional momentum. So cross-sectional momentum is the same as trend, except it's what's called delta neutral. So you're simultaneously going long the things that are going up and short the things that are going down in a way that's perfectly balanced all the time. Cross-sectional carry, we've already discussed. We have some offshoots of that research, which is a thing called premium. Premium is the thing which the funding rate is based on, the difference between spot and futures. So let me show you what that looks like. Let's look at Bitcoin. And let's look at it on a 12-hour chart. So this is premium right here. If we turn this into a signal, go long when it's high, go short when it's low, go long when it's high, you would think that's not a signal, but it actually is an edge. And because this is how the cross-sectional carry system is calculated, it's like a forward-looking predictive version of carry. We also discovered, through the simple expedient of asking one of our hedge fund mates who trades $1 billion fund, what else could we do with this? And he said, oh, you could change in premium, we also trade. So most of the research that we do starts by asking our smart mates who trade $1 billion funds, hey, what do you do here? And usually they tell us because we're friends. And so we've got cross-sectional momentum. Now, let me show you some nerd stuff. If I'm getting too nerdy, tell me to fuck up in the chat, and I'll shut the fuck up. Okay, so this is some code. So we have some things that are predictably fucking. So just downloading some market data. We have some things that are predictively fucking with our attempts to get cross-sectional momentum going. This is what a scatter plot works like. It doesn't look very nice. Why is that? Because, like we've already discussed, there's a size factor in crypto. It works better. Trend works better on the Bitcoins. It works better on Bitcoin than it does on Ethereum Classic. And we can see that the raw scatter plot does look like arse, of course. And we can see that this is a decile of size. And we can see that the small, we can see that it works much better as the size changes. So if we do it on the top, if we do cross-sectional momentum on the top 200 perps by market cap, this is an edge. Anything that makes money is an edge, but this is kind of shitty. Our problem is that we're comparing price changes on a bunch of stuff that isn't really that similar. We're not doing an apples for apples. Some coins are more volatile than others. Some coins are bigger than others. Some coins do different things. Some are Ponzi's, some are meme coins. They have predictably different sensitivities. So we could try restricting it to a larger market cap, and we can see that a more consistent cross-sectional momentum effect on our universe that's a bit more the same. So this led us, if we just do this on the top 50 perps, that starts to look a little bit better, right? Let's look at what it started with. The top 200 perps kind of looks like shit. On the top 50, that looks okay. But remember, trend returns and all returns in algorithmic trading scale with the square root of the number of independent bets. So by the time we fuck with them a little bit, we can get trend working out. By the time we adjust for this size effect, we can make it work on smaller coins, which is something that we're doing right now. The next thing that we're doing is open interest conditional on aggression, the same way as the market buys versus market sells. Open interest on perpetual futures is a noisy signal. We can clean that signal up, and it looks to be good too. We can get trend working adjusted for size on the small coins outside the top 50. So these are very, very big changes that we've been making. It's a quantum leap in the system. So this is about creating generational wealth from crypto. You know, if you're earning 100% a year, by year 5, you're within sight. You're just a couple of turns in the bend away from the 8-figure goal, which is my goal. And, you know, carry is a mediocre edge, but when you blend it with trend, it looks great. Now, we build a custom system for every user. We can dial it up or down the risk. You've seen with these, we have high risk and lower risk versions of everything. So this is the difference between retiring at 40 and retiring at 50. It's been life-changing for me and my family. I want to give you the deal of a lifetime. We have 3 tiers of FinRev. FinRev Silver is $1,000. It's a signal service. You have to enter the trades yourself. It's going to take you about probably 30 minutes total of work a week. It's not automated. You have to do it yourself. We have FinRev Gold, which is the system that I've shown you all the results of today. It's the system I'm personally using myself. It's amazing at the end of the year, but on any individual day, it probably can break your heart. It's $6,500 for 3 years of fully automated trend following trading. Why do we charge in 3-year lots? Well, because if you give up after a month, like someone just did, then it's going to be a waste of your time. This is really a multi-year play. You're never going to 100x your money in 1 year. You will in 20. FinRev Platinum is all the things that I've just shown you. All of the extra systems, all of our future upgrades. And it gives you the ability to run multiple accounts. This ability to run multiple accounts lets you do something very cool. Let's say you're worried that Binance might fuck you and pull an FTX. You can split your money between Binance and FTX and Bybit. You can split your money up any way you want. You can also do something very cool. Let me show you. You can run a DGen account. And let me just load a DGen account. I'm just going to have to get out my authenticator here. You have to use an authenticator to log in. Sorry, it's just taking me a minute to log in. Okay, let me share screen again. Okay, this is our CTO, Timon. He put $235 in this at 100 volt, which is like a completely irresponsible. I gave him so much shit about it. We had so many arguments about this shit, right? Like, it was so painful. It nearly destroyed our friendship, actually. I'm like, dude, you're designing trading systems and you're running at 100 volt. Like this means that you don't understand this shit. And anyway, his $200 over time did nothing for a year. And then we got a bull market and his $200 quickly became $2,000, then $5,000, then $7,000. Then he lost a bit and then it went up to $19,000 in 1 day. It was down to 12. And then he got to $21,000 and then got as low as $11,000. And $13,000. So essentially what he did is he made an algorithmic trading system that trades like a fucking meme coin from $200 to $13,000. What FinRev Platinum gives you the ability to do is to run multiple accounts. And actually, before I stop sharing that, let me share it again. And I'll show you my own. So I also have a DGen account.
Not on screen just yet, dude.
Yep. All right. You can see okay. So this is my DGen account. I've lost money on it. I put 90 grand in. I'm at $86,000. I'm trading at 90 volt. And I started trading 13th of March. When was 13th of March? I started trading right that day. So I haven't done very well. At 90 vol, which is an irresponsible leverage, you lose money if the market goes sideways. if we get another thing like we got earlier this year, please let us get it. That could easily become $5 million in a rip-roaring bull market inside of 6 months. Obviously, you know, my net worth is about 12 million bucks. 90 grand isn't gonna break me either way. If this was your whole stack, this is not something that I would encourage you to do. But let's say it wasn't your retirement account. Let's say it was just you think crypto bull markets are going to be a big thing, but you don't know anything about crypto and you just want to take a big swing. That's the way to do it. Okay, so let me get back to the presentation and I'll show you the deal. So FinRev Platinum is 9,500 for all the extra stuff I've shown you, the ability to run multiple exchanges, multiple DGen accounts, all our systems, including future upgrades. What do you get? You get 3 years of automated algorithmic trading with FinRev. You get a VIP onboarding with one of our experts, like not some customer service guy from fucking Uganda or Philippines or wherever. You get someone who's actually got their own money in this system. Everyone in the company has their own money in the system. Ian, you got money in the system?
Yeah, I got 3 accounts.
Yeah, exactly. Me too. So does everyone. We all do. You get all the stats and the monitoring that I've shown you. You can delay or start, pause at any time. So, for example, I'm red hot on Retardio. It hasn't been it's been a good investment. I put 5 grand into it. It was as high as $250,000 at one stage. Now it's back to 100 grand. It's like, if you think you have an opportunity like that, you could pull that 90 grand out of that and stick it into Retardio and then pause and start and do all that stuff. You can delay starting if you have to move some money around. If you want to wait for the market to come back a bit before you dump it in, you can do that. We've got a double your money guarantee. If you aren't in profit after your first 12 months of your system, we'll let you use it for free until you've doubled your money. And finrev.trade/call if you want to get this, if you want to get the silver, the gold, or the platinum. If you want to try the gold and upgrade to the platinum, if you want, you're welcome to do that. Just pay the difference. Platinum, you get the same 3 years VIP onboarding, the same stats and monitoring. We build the system custom for you and your goals. If you want to push the boat out on leverage, if you want to run a barbell strategy, if you want to, whatever you want to do, we build it custom, and we're grandfathered into new systems. It's both trend following, cross-sectional carry, cumulative volume delta, cross-sectional momentum, premium, delta premium, all the new stuff. Same W money guarantee, finrev.trade/call. Actually, don't email me at this because I don't answer it right now. It's a fucking great system, guys. Like, I've taken up enough of your time. Like, who do we talk to about? Carrie will be on like super soon. Stablecoin yield within FinRev DYDX version 4. DYDX version 4 is complicated to do that because it's not set up for it. It's a very, very easy thing for us to add it to Bybit. It's complicated to add it to DYDX version 4. So it's on the list, but it's quite a way down the list. Guys, I've taken up enough of your time. I've shown you. Gold moves sideways for periods. Gold and FinRev don't have a relationship with it. They are technically uncorrelated, which means that there's no like this one goes up while that one goes down. They're just completely different sports.
Nice. That was an absolute banger. Thank you so much, Scott. Yeah, thank you, Dusty, as well. Cheers, bro. Have a great
All right.
weekend.
See
Thanks,
ya.
everyone.